Well, hey there, everyone. Happy Monday, April 6th. Happy Monday after a long holiday weekend. Happy Easter. And welcome back to normal trading day here on Monday, April 6th. I'm Dave Keller, host of Chart This with Dave Keller. And thanks for joining me here from a beautiful, beautiful sunny day here in Redmond, Washington. As we're decompressing after the holiday weekend, taking a look at what happened today. Nice continued upside. It wasn't a big upward surge, but it certainly felt like a continuation of what we're still inclined to label as a counter trend rally off of those lows, right? 2 weeks ago, all about risk off. Last week, holiday week, all about risk on. The question is going into this, sort of week after the holiday week, before earnings, before economic data, which is coming out as the week progresses. How do things do? How do things do today? We finished near the highs of the day. The S&P 500 closing above 6,600. It's not bad. We're still not above the 200-day moving average. The momentum still is not as strong as you'd want it to be. I would argue if you're all bulled up, and when consumer staples are at the top of the list, how bullish do you want to be? I don't know. Some interesting mixed signals here. Breadth indicators turning better on the short-term breadth indicators. Long-term breadth indicators still feeling more risk off to me. With that in mind, let's look at how the markets played out today. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. Thanks to those of you that are tuning in live. I appreciate you participating in the show. You're welcome to ask questions as we go. I can see anywhere you are streaming the show. If you ask a question, I can see it here if you use the comment section. We'll take a question or two as we go. Any of the questions we don't get to, we'll put in a mailbag episode slated for this Friday. Last Friday, we had a great episode, a mailbag episode. Markets were closed for the Good Friday holiday. We had some really thoughtful questions from you guys in recent weeks, which we took some time to answer. So make sure you check that episode out and keep the great questions coming. Here's what happened in the markets on a Monday here in early April. S&P 500 up 0.4% to close just below 6612. Decent follow through from Thursday's close near the highs. And NASDAQ composite just slightly better, Dow slightly worse, but all a decent amount, 1/3% to 0.5% higher. Mid caps and small caps, all about similar. No real message, I would say, today in terms of large over small or small over large. They all kind of generally drifted higher today. Volatility ticking a little bit to the upside as well. And so the VIX has come down from extreme levels above 30 to now still high levels above 20. So we're not in a low volatility environment. We're still in a high volatility environment. That tells me to brace for larger percent swings, or at least that's what the options market is pricing in right about now. Let's look at some other asset classes here. You can see the 10-year yield finished higher by just a slight amount. We're just around 434 at the close. The long bond yield just below 4.9%. That's not much of a change from Thursday's close. So 10-year yield basically a little bit higher here, but not too much to the upside. The dollar was basically flat. Bond prices, treasury bonds, that is the TLT, slightly lower. So not a huge move, to be honest with you, in the fixed income space. That's something to watch, though, because rates have moved quite a bit as headlines out of the Middle East have fluctuated. So when things looked pretty dire, we saw rates pop up pretty good. And then when it was implied that there might be a resolution a lot quicker than expected, rates came down very, very quickly. Now they're kind of holding in there at a fairly elevated pace relative to where they've been here for the last month or two. Mixed results today from gold and silver. You can see the GLD was down slightly, about 0.4%. to 427 and change. The chart of gold, I mean, it's still okay. I mean, it's best okay. It's similar to the S&Ps, right? I mean, it's in varying stages of okay. I mean, they're below moving average support, at least the ones you want it to hold. It's kind of not quite holding that. But is it breaking down anymore? It's not at the moment. So an open question. Silver up about 0.5%. So silver over gold was the trade today. Crude oil prices, natural gas prices, drifting higher here. So crude oil prices up, energy stocks up, no resolution yet to events in the Middle East, but just further discussion and debate is what I would say. So Bitcoin having a pretty awesome day, to be honest with you. I mean, only up 1%, but trading just below 69,800. So we're right testing that 70,000 level. Big round numbers tend to be pretty meaningful for the chart of Bitcoin. If you look back in the last 5 years or so, right, it's often been a pretty important inflection point or a pivot point around big round numbers. 70,000 is that level. 75,000 is a real level for me. I did grab a chart of Bitcoin just to show you a Fibonacci analysis on the most recent downturn. Kind of confirms why 75K I think is the level to watch. At least that's what I'm watching to add Bitcoin back to my portfolio. I'm kind of out at this point, given the choppiness and the downtrend that we experienced. All right, looking at the 11 S&P sectors, consumer and consumer at the top of the list. That has not happened very often. And part of the reason is because consumer staples is generally considered a more defensive sector, consumer discretionary, a more offensive sector. So they usually are not neck and neck on the upside or the downside. But today is one of those unusual days where consumer staples, the XLP at the top of the leaderboard, up 0.9%. Consumer discretionary, number 2, up 0.8%. Energy, number 3, and financials as well, both up about 0.7%. Earlier today, I did a top 10 charts to watch for April 2026. That was for the Stock Charts TV YouTube channel. And we talked a little bit about financials. I think Bank of America, BAC, was the stock that I grabbed for that. I might have actually grabbed that for today's show as well. We'll see what happened. I was throwing a bunch of charts around a bunch of lists earlier today, but the XLF, a number of those stocks pulled back pretty good. A lot of them did well. The big banks in January and February. March was a big drawdown for a lot of those, but just starting to turn higher. And Bank of America is just threatening to get back above its 200-day moving average. It certainly has that feel that there might be some additional accumulation coming in. So we'll share that chart. That was one of the names that we talked about in that weekly show on Stock Charts TV. On the downside, only 3 of the S&P sectors lower, and not by much. These are all down about 1/3% for the day. Materials, utilities, and healthcare. Materials and utilities are interesting because those are the two of the top performing sectors year to date, if I remember right. On a relative basis, those are some of the sectors getting it done. I actually grabbed the chart of utilities to share with you in a little while. Looking at the breadth data, we can see advancers versus decliners favoring advancers. You can see most of these breadth readings for the major U.S. indexes are in the bullish category. On the NYSE, 61% of that index was up compared to 36% down. On the S&P, just a little bit better, 64% up to 35% lower. Again, as I mentioned earlier, pretty consistent across cap tiers. This was a pretty even day. No real theme, I would say, in terms of large to small or small to large. They all kind of were drifting higher together here. Breadth, pretty good, right? Pretty good breadth conditions. On our market trend model, we were updating our premium members with our weekly flight plan this week. That the short-term model did turn bullish for the major U.S. indexes on Thursday's close. I update that every weekday or every week at the close. So last week it was Thursday before the Friday holiday. And so we're in that weird kind of position where short-term is now bullish. That means the tactical trend is now positive. That's the short-term counter-trend rally. The medium-term trend, by my analysis, still remains negative. And then the long-term trend, that secular trend, still remains positive. So we're at a sort of a weird one of those weird moments where there's mixed results, to be honest with you. Even breadth conditions, to be honest with you, are not completely bullish or bearish. There's some bullish and some bearish, and generally it's the more short-term oriented ones like the McClellan oscillator that are the most bullish right now, given the strength of the move off of the March swing low. Looking at the Magnificent Seven and Friends mega cap growth trade, we can see Amazon and Alphabet both up 1.4% today, so that's not too bad. Apple, number 3 from the top, up 1.2%. On the downside, Tesla continuing to underwhelm relative to these other stocks, down over 2% today. The rest were flat to slightly higher, and some of the big technology names, particularly big chip makers, Broadcom, NVIDIA, essentially flat for the day today, not really being pulled up with the rest of the equity space. All right, we're going to look at a heat map now and pay attention to some of the movements today. As a reminder, if you're watching live, drop questions anywhere where you can drop a comment. If you're watching the replay on our YouTube channel, just use the comment section below the video. And we'd love to hear from you and answer some of your questions, maybe in our mailbag episode on Friday. All right, here's what happened today. And again, breadth was slightly positive, and that's kind of what the heat map looks like. You can see some sectors a little more positive than others, although generally this is a pretty flat day. Not a lot of huge percentage swings here as I'm looking at the complexion of the heat map, or what's called the market carpet on stock charts. Things that come to mind here. Oh, whoops, hold on. I was gonna say this didn't look quite right. There we go. Boy, isn't it funny when your brain tells you something's not right? As I'm talking, I'm looking, I'm like, these colors look just slightly off. Sure enough, I was tinkering with a bunch of these things, and I was looking at RSI at one point earlier today as I was looking for some stocks to think about. So there we go. Okay, now this makes a little more sense to me because I was going to say I know there were some names that moved a little bit more than that. Here we go. Erase what I just said. Here we go. Performance today. 1 day performance, percentage change. Here we go. So what does it look like? Definitely a slightly positive day. I'm noticing within the technology sector, the biggest names were not the biggest drivers of that sector's return. And that's part of why, even though the technology sector was up, it wasn't at the top of the leaderboard. And you can see because some of the biggest names that have huge weights like NVIDIA, Microsoft, Broadcom, 3 of the top 5 were basically flat to slightly down. And Oracle, stock number 5, was down as well. So only Apple out of that top 5 was in the positive. And so that's why the technology sector did not necessarily do as well as some of the other sectors. However, I would note there were some names that did very, very well. Keeping an eye on Western Digital and Seagate especially. Seagate did make a new 52-week high today, closing up 5.6% today. We'll look at that chart. I did grab that chart. Gapped higher. The candle did not look particularly awesome, though, as I was looking at it going into the last hour of trading. We'll see how things finished off. AppLovin is an interesting one, testing a potential double bottom pattern. I did grab that chart so we could dig into that a little bit more. And, when you think about the technology sector, charts like LRCX are the ones that kind of are in the back of my mind. I mean, this is a neutral chart right now on the medium-term time frame, right? If we're looking out like a month, this is neutral, right? Because if you look, the trend is basically sideways. We're the same place we were at the beginning, first week in January. So for the last 3 months, we've gone nowhere. We have chopped around, but directionally we are flat for that period. Look how the RSI has settled in between 40 and 60. Look how the relative strength is generally flat. I mean, this is kind of like a treading water, right? This is not really accelerating. It's not really showing accumulation. It's really more stagnant, right? And it's not distribution. We're not seeing a breakdown of support. We're seeing buyers come in around that 200 to 205 level. So we have a clear level of support. We've got some clear resistance that we've been unable to eclipse. And at this point, the 50-day moving average is now flat. This is a stock in transition. This is a stock in, Jesse Livermore's quote, there's time to go long, time to go short, and time to go fishing. This is a time to go fishing. It's time to wait for the chart to give a clear signal. So with this kind of chart, I kind of really think about the range here, right? You think about this as a rectangle that encompasses sort of the, the general stuff here. So like this is what the stock has been doing, right? We're kind of in this triangular or rectangular shape. We've got clear resistance around 250. We've got clear support right around 200. At some point, one of those is going to break, right? We're going to break out above the upper boundary or break below the lower boundary. But either way, like that's the signal. Right now, it's more noise than signal. So let's just wait. Let's be patient. Let's sit on our hands and wait for the chart to give a clear indication one way or the other. Alphabet's an interesting one because it had a clear breakdown below 300, but now we're rallying and testing that breakdown level from below. I think Alphabet getting back above 300, showing improved momentum would be a really bullish outcome to what was a fairly painful Q1 as the quarter progressed. So far, we're getting a nice bounce into the beginning of April here, and let's see if we can continue that. So Alphabet, out of the Magnificent Seven charts, it's Netflix and Alphabet that I think are most compelling. Maybe Apple as well, bouncing off of support as well. Maybe those 3 I would put on the list. I mentioned the financial sector, and again, I mean, charts like JP Morgan are not great charts by any stretch, but they're becoming less bad, right? A lot of these kind of broke down through support, and now we're just starting to show a bit of a rotation just in the last month. So it's more on the tactical time frame that I'm seeing a bit of an upturn, but I'm seeing that across a lot of different areas of that sector. And that's a sector that struggled quite a bit toward the end of the first quarter and really through much of the first quarter. So an area to watch. I think a lot of those are still sort of, not quite proven yet, but certainly something to watch. A bit of a bounce here on some of the aerospace and defense names. You can see Boeing up about 2%, LMT, Lockheed Martin, back above the 50-day moving average. Both of these are sort of hooking higher a little bit. It's kind of a head scratcher in March. A lot of these defense names had incredible runs in January and February. They all came off in March, even as events in the Middle East were really accelerating. So a bit of a rotation higher could make sense here. Boeing has a lot to prove. Have to get it back above the 200-day moving average. By the way, we went to the Boeing Future of Flight Museum over the weekend, and you actually get a tour of the Boeing plant up in Everett, Washington. If you can get to Seattle, it's really cool. It's the biggest building by volume in the world. You could fit the Taj Mahal in it. You could fit all of Disneyland in this building where they build these huge jets. It's on. You get to go up on a deck and see the jets in various states of assembly. It's pretty awesome, actually. The chart not awesome yet. What I'm looking for on the chart of Boeing is similar to what we saw like in December, right? You rally up to the 200-day moving average, and then you follow through on stronger momentum, right? And I think those are the components to look for. When you have a stock that's broken below the 200-day, I kind of look for three things really quick. Number one, can we regain the 200-day? Number two, can we follow through and show additional accumulation above the 200-day, which shows you buyers are willing to pay more? And number three, do we see supportive volume, meaning the RSI pushing above 60 on that breakout? And so, here in late November, kind of risk off below the 200-day weaker momentum. Between that and mid-December on the chart of Boeing, all of those had been fixed. We regained the 200-day, we followed through, and then the momentum improves in that period. And so that's what I would be looking for here. That'd be like the all clear for Boeing. I still think it has more to prove before that is the obvious scenario. That could happen, but I'm just not seeing enough yet. Right now, I'm seeing a counter trend rally to the 200-day. Those components I talked about in mid-December are what made a Boeing chart pretty constructive, basically telling you we're going to retest that previous high most likely. So something to watch there. What else on the heat map before we go on to some other charts to watch? I have to point out consumer staples were at the top of the list. Consumer discretionary, number 2 on the list. The number of interesting charts in here. These are fairly diverse sectors, to be honest with you. So within consumer discretionary, you've got internet names like Amazon. You've got home improvement names like Home Depot. You've got restaurants, travel and tourism, hotels, auto parts. It's a whole mishmash of different businesses. So not surprising that there's quite a bit of variation there. Consumer staples as well. You've got like the big box retailers that honestly could be bucketed in easily in consumer discretionary charts like Walmart and Costco. You've got tobacco names, beverage names, food products, personal care products. There's a bunch of different stuff in the consumer staple sector that is. But this is the top performing sector today, and I'm immediately drawn to the big box retailers, right? Because Costco looks like this. We're kind of breaking to a new swing high, completing what I would probably say is a bull flag pattern of the run higher, the pullback, lower highs, lower lows, and we're resolving that pattern to the upside. This is also an important one because it's regaining 1,000, which is a big round number, which is usually more important than you'd guess. And so getting back above 1,000 on improving momentum, I think resolving that bull flag pattern to the upside, nice follow through today. I think it's an encouraging chart. So big box retailers, probably some of the more encouraging charts I could show you within the consumer staples sector, because a lot of these like Kraft Heinz, a lot of the food products names have been beaten down quite a bit and are trying to recover off of those crazy low levels. I think that's it for the heat map. Let's continue and look at some charts together. Before we do, quick shout out to one of our partners, EPS Momentum. If you like price, which I think you do because you're following my content and watching my show, and if you recognize that earnings are important, which I hope you do, because I would wholeheartedly agree that over the long term, price tends to follow earnings. If you can get the earnings right, you're generally going to be on the right side of different companies. EPS Momentum is a newer product that really does a fantastic job of creating models to break down price momentum and earnings momentum. They have some really good scans to help you look for complementary moves where price and earnings are both showing strength compared to previous cycles. You can go to marketmisbehavior.com/EPS for more info on their platform. You can get 30% off if you follow that link and check out a new subscription. I'd encourage you to check it out. Thanks again to EPS Momentum supporting the channel. All right, let's look at some charts together, shall we? Here is a daily chart of the S&P 500. We're going to start there. We are back in the neutral reading on our proprietary and very subjective Dave Keller color coding system, the traffic light approach, which is just me visually indicating some of the key levels that I think we want to pay attention to. We're back above 65.50. That's a good thing. Now the question is, do we regain the 200-day? Do we do so on stronger momentum? And you've seen me refer to that combination on a couple charts so far today. That's kind of my general playbook when you have that initial break below the 200-day moving average, because there's two ways that this generally goes from here after you've had that big break of the 200-day, right? Once we've broken the 200-day, even the most bullish of the bulls have to recognize that something's changed, because if we were really bullish, we wouldn't be below the 200-day. So at least we've had an initial break. Now the difference is either this is a counter trend rally to the 200-day before the next big leg lower. That's what happened in March and April of 2025. Just go a year ago and you'll see a perfect example of that kind of counter trend rally before the rotation lower. The other option is we regain the 200-day and then we see additional accumulation, right? And that's the example we saw with Boeing, where it broke below the 200-day, broke back above, and then you saw the breakout on stronger momentum. So the way that you differentiate between the two, because they look very similar on that initial rally higher, is number one, you look for any key patterns around the 200-day. You see any short-term signs like candle reversal patterns that tell you maybe this is going to continue or maybe not continue. And that was one of the great signals I think we got in March of 2025. Question number two, do you see momentum supporting? Meaning, do you see the RSI push above 50 and ideally above 60? That's a real sign of accumulation, right? Market breaking out, price breaking out on stronger momentum. That tells you there is a big amount of buying power, momentum pushing this price higher. Otherwise, it feels much more like a counter trend rally. So we need to regain the 200-day and not have any, scary reversal signals. We need to have a lot stronger momentum than we've seen so far. The RSI and the S&P is still below 50. The price is still not regained the 200-day moving average. This feels to me like a counter trend rally to a pretty clearly expected level of resistance. If I'm wrong, price goes back above the 200-day, momentum continues, and then all of a sudden it looks like a pretty strong V bottom. And then we just look for higher lows. We look for ways to track that price above there. But we're really at a critical point. You can go back in market history and see examples of where both have happened. So from here, it's about how we trade around that 200-day moving average. One of the ways we can think about that is looking at breadth conditions and looking at the companies, the hundreds of companies that comprise the S&P 500 index. Here we can see that we're up to 34% of the S&P 500 members as of today's close above their 50-day moving average. That's up from around 20% about a week and a half ago. That's good. That's encouraging. Getting back above 30% is often a sign when you go back. Getting below 30% and then popping above is often where a short-term bounce kind of plays out. And that's really in the midst of where we're at. The long-term breadth, though, is still kind of negative, right? So we're still below 50% here. So we're seeing stocks regain the 50-day. We're not really seeing enough, just like the S&P, not quite getting above their 200-day moving averages. This indicator going above 50% would be one of those upside validations, right? If we think about the S&P going higher on stronger momentum, long-term breadth measures starting to improve, showing that there's a broader return to risk on, not just on the S&P chart, but other charts as well. I think that would be a good validation as well. I'm unhappy to inform you, if you were looking for the Zweig breadth thrust to give a signal, we're out of time. We're 2 weeks now after that reading where the indicator went below 40%. The Zweig breadth thrust is an indicator. It's a type of indicator called the breadth thrust, which means really negative breadth to really positive breadth. The Marty Zweig version means we go below 40% to above 63% within 2 weeks. This green line is a moving average, an exponential moving average of the raw data, looking at advancers as a percentage of total listings on the NYSE. This is the stock charts version that we're using here just for clarity. And, basically we had 2 weeks from that signal getting above 40%. didn't quite get there. You can see on this chart the previous indications of where it has actually followed through. And you can probably see why we think of this as a pretty important indicator, because when it signals, it's usually a pretty good sign for stocks, right? And if you look 6 to 12 months out, pretty much all the time the market's higher. And so that sort of signal indicates quite a bit of strength off of a low. We did not get that confirmation here, which just means we reset. And at some point, the breadth probably goes negative. We'll reset the indicator, and then we'll keep an eye on it. We'll let you know if that initial reading triggers again. But for now, not enough time. Did not trigger, so we have to move on with our lives. All right, looking at Bitcoin, look, I just zoomed in a little bit to show you this Fibonacci framework. It's the way I generally describe when you take a chart and you sort of look at a major high and major low, sort of give yourself a sense of the range. And then we use Fibonacci retracements to identify some potential reversal points between those extreme levels. And I have shown this in some form before, but I hadn't done it recently. I just wanted to update where we're at here. So if you look at the January swing high, that's around 98K, and you look at the February low 2 months ago, which is around 60K, we had an initial rally right to around 74 to 75,000. If you look, that actually represents a 38.2% retracement of this big downturn. So we stalled out right here. From a Fibonacci perspective, that makes a ton of sense because that's the initial upside target. When you have a major low and you start to rally, that's where you'd expect sort of that initial upside objective. It was reached, and then we pulled back. So what that means is now that we've rotated higher, this is now where we have confirmed resistance, kind of in that 74 to 75 range. That's where we've had these peaks in the month of March. Getting back to that level would be great. Getting above that level would be great. That would tell us, okay, upside follow through. We're seeing risk on continue above there. This structure here is one of the reasons why for now I don't own any Bitcoin. I'm waiting for a break above that 74 to 75K level. If we would get that valid breakout, I take a position because I think it would be worth gaining exposure for further upside potential. But until then, this is more of a choppy sideways chart. As we mentioned before, looking at the momentum on those breakouts matters as well. So let's make sure the RSI gets above 60 in that breakout scenario. All right, here's the chart of Netflix. I just want to show that the rally that we had off the February low, here's that gap when the Warner Brothers deal was called off. We had a couple gaps over a 3-day period. We ended up getting up to right around $100 a share. That's also just above a 38.2% retracement of this big downturn from the latter half of 2025 into the February 26 low. So we gapped higher. We ended up stalling out right at the Fibonacci level, just above there, actually at $100 a share. Today, we opened above $100 a share. So earlier in the day, I had an alert set. It popped up. I'm like, ooh, Netflix finally breaking out. This is really good news. Here's the bad news, though. We ended up closing back below that level. So this is one of those, defeat snatched from the jaws of victory kind of thing. It looked really good at the open. Even as the morning progressed, it looked like we were making some upside progress. But by the close, we were back near the lows of the day. So still technically an up close from Thursday's session, but not that big follow through, right? And that's why I always talk about when there's a breakout, you want to see follow through. You want to see a breakout and then signs that additional buyers are willing to take on positions at a higher level. That's what causes the price to go up. This scenario is more of a higher open, but then it's heavy through the day, which means traders are selling on that short-term strength, which does not give me as much optimism that we're going to sustain a move above 100. So I think for Netflix, that means wait and see if we can get that confirmed breakout above 100. The momentum's good, so let's get some stronger price action to match that. Still could happen as the week progresses, but not quite there. I'd mentioned on the heat map the chart of Seagate Technologies. Here's the good news. We broke out of that coil pattern. We've been talking about this coil pattern of lower highs and higher lows, kind of consolidating around an equilibrium price of around 395 or 400. Wednesday and Thursday of last week, these two nice up candles, right, bringing us to the upper boundary. And the question going into this week, which way? Do we gap up? Do we finally follow through? Which we did. Here's the bad news. Similar to the previous chart, we had a bearish candle pattern on the breakout, right? So this is a shooting star candle. Thank you, Larry. 100% correct. Shooting star candle is right. We have the open and close near the lows of the day, limited lower shadow, long upper shadow. So again, with both of these charts, what initially looks like a really good development, which is the higher open, the fact that there wasn't more selling, right? If this was really bullish, you'd see buyers coming in, we see further demand, we see the price close up toward the highs of the day. We saw traders selling into that gap higher. And so by the close, we're back near the low. So what that implies is the next 1 to 3 bars more likely weaker. So the good news is like STX breaking out of that pattern to the upside. The bad news is the candle pattern not really validating that. This is one of those times where I do find candle patterns pretty helpful because they give you a short-term read on how traders are reacting to some of the bigger moves that we're seeing, and a great way to kind of validate or maybe invalidate one of the patterns that we're seeing on the longer-term charts. I'd mentioned AppLovin. This is a stock, if you remember, that IPO'd after COVID. After the COVID kind of lockdown period. This is in 2021 IPO. From there, kind of had a nice bounce, but then 2022, if I remember right, was an absolute disaster. And then 23, 24 into 25, remarkably strong. Now 25 has kind of finished in a position of strength, but 2026 kind of rotating lower. We have this pattern. This is what I'm concerned about with the S&P, a breakdown below the 200-day, a rally to retest from below, and then we rotate lower. Now what's happening, though, is AppLovin is testing this key support level. So from a risk reward perspective, if you use these lows as your initial stop, you're not putting much at risk because you're limiting your losses and you're betting on a potential return back, essentially back to the 200-day moving average is how I would think that, right? So it's like you're limiting my losses to this and have the potential return going up here. So risk reward, pretty favorable, right? Which means you're putting a little bit at risk for the opportunity to gain a lot more. And that would be the setup here. What's interesting is this doesn't look like that big of a move, but these are deceiving. These are huge price swings on a percentage basis from one point to the other. So getting from 412 up to 516, that's 100 points. That's about a 9 to 10%. Is that true? No, that's more of like a 20 to 25% rally. 100 points on a $400 stock to get up to that level. So, that's a big rally just to get back to that point, big percentage gain. So interesting setup here with AppLovin. AppLovin's one of those where it's not a super bullish chart yet because it's still, at best sideways, but it's not going down anymore. It's kind of setting up that, that range. And now do we bet on a return back to the upper end of that range up to the low 500s? Potentially. That's an interesting setup for us. I mentioned some of the financial stocks. And again, a lot of these are looking really good in the last couple of weeks. BAC, it's like, great. I'm glad we're recovering a little bit. I'd love to get above the 200-day moving average. Standard comment, want the RSI to push higher. So it's like right at that point where we could get above the 200-day on an RSI above 60. If that would happen, fantastic setup, fantastic chart. Otherwise, I'm skeptical. So color me skeptical right now, but the whole financial sector kind of improving here as we go into April. We'll see. We're obviously going into earnings. Starting next week, we're going to get a fire hose of sorts over a 3-week period of a bunch of quarterly earnings reports. There's going to be a lot to unpack there, but I think financials in particular, which tend to report more at the earlier part of the earnings season, that could be a catalyst that could propel charts like BAC back above the 200-day. That's what I'd be looking for. I already talked about the chart of Costco, so I don't want to beat it too much more, but just noting a bull flag pattern, which is a rally, this sort of pullback phase, getting above the upper boundary of that pattern is important, which I would say Costco has done. We're now breaking back above 1,000, big round number resistance on improved momentum. I like that setup. Final set of charts in the utilities sector. When you look year to date at some of the returns, strongest returns, utilities are up there. They've actually had a pretty good 2026 so far. The yield or the income component on these names are higher than average. You can see the XLU has a forward yield of around 2.7%. That's much higher than the average for the S&P. Volatility tends to be a lot lower. So these are names that tend to outperform in a down market because they're lower volatility. So if the S&P and the NASDAQ are down a ton, these stocks tend to be down less. And that's why they're generally thought of as good places to be, to park your assets in equities, or still in the equity markets, but be in a more defensive positioning, higher yield, lower volatility. A lot of these are more growth stories, right? They're driven by the incredible energy needs of AI and cryptocurrency mining and all those other things that take a ton of computing power. What's interesting is the chart of the XLU is a pretty good setup. Here's my quiz question, and I'll show you the answer in a second. How many of the S&P sectors are currently sitting above both their 50 and 200-day moving averages? And here the hint is at least one, because here's utilities and they're doing it. How many other sectors can say that? The answer is not many, right? If we go to the candle glance here, this is a way on stock charts, kind of throw a bunch of charts up like this. So these are the S&P and the S&P X technology, just some benchmarks. The rest of these represent the 11 S&P sectors. How many of these are above both their 50 and 200-day moving averages? So utilities, that's a thumbs up. Real estate, not quite above its 50 days, so no. Materials look like they're just still slightly below their 50-day, so no. You're correct, Larry. Energy is the other one that obviously is. So it's actually the only two right now are utilities and energy. Materials, not quite. Real estate, not quite. But those sectors, if you think about the sectors that are above their 50 and 200-day and the ones that are almost above their 50 and 200-day, three of them are super defensive sectors, right? And so that's the environment I think we're in right now, right? We haven't seen that big resurgence in offense. And so the XLU setting up with a pretty decent price structure and with strong relative strength seems pretty interesting. Some of the larger holdings within the XLU are names like NextEra Energy. This is one that's been really sideways, but still holding key moving averages and trending higher. Dividend yield pretty healthier. Here's AEP, which is more of a conventional utility provider, like in the Midwest, if I remember right. 2.9% forward yield. Again, similar to the XLU. These are decent price charts, right? I mean, how many charts do you know of that are above upward sloping 50 and 200-day moving averages? Not a lot. But these are ones that also tend to be lower volatility and have a decent income component. So in this environment, boy, it's fascinating to me that some of the more compelling charts are in some non-offensive areas of the market. All right, I'm going to scan for a question or two just to take out. Hey, I don't see any that we need to necessarily throw up here. I see some great comments on candle patterns. Jay Ross, I'll take your question. So is a hammer the opposite of a shooting star? Yes. The short answer is yes. I have some notepads somewhere where I have these thrown on and I randomly put them on there. But here's the here's a way to do it, right? So if you can see that, that's a hammer candle. If it comes, market going down, that's a hammer. Market going up, and you see that, that's called a shooting star. They have different names if they happen in the opposite market, but that's exactly right. Those are the ways to think about it. So in an uptrend, the shooting star, the open and close near the lows, and then a big upper shadow. In a downtrend, a hammer, open and close, long lower shadow. Think of it like hammering out a bottom. Really valuable one candle patterns to keep an eye on. I do see a couple other questions. We're going to put those in the mailbag and maybe answer them in our Friday episode. If you're watching the replay on our YouTube channel, hey, take a moment and ask a question. Anything about market conditions, about different technical indicators, different tickers or ETFs that we want to go through, throw them our way. In the meantime, have a wonderful night. Heads up, I'm actually traveling to Southeast Florida over the next 24 hours to get down to the Money Show, which is happening in Hollywood. You can sign up for that event at marketmisbehavior.com/money show. If you are attending, please come to my session and say hello. I'm actually presenting on Thursday, but I'll be traveling tomorrow. Not exactly sure when I'm going to get a show in. Probably most likely not be live. Probably will put a recap video out when I can. So thanks for being patient. We'll watch the charts and update you on the markets as soon as we can. Have a great evening. Remember, it's always a good time to own good charts. Take care, folks.